Hello, welcome back to the continuing lecture in investment analysis. So, in our last session, we took a look at an example of how uh, we construct a arbitrage portfolio and exploit the arbitrage, which is zero investment, risk-free alpha that would always give you the uh, uh, that extra, right, alpha, uh, and regardless of whether alpha is actually positive or negative, because uh, if it is negative, we simply need to switch the algebraic sign of uh, the weights, right? So our idea was, basically like this: portfolio weight. Our basically the risky our y is, in other words, our um, explained variable or dependent variable is S&P 500, which is a portfolio P, and we are basically using uh, broad market and called benchmark as the explanatory variable, and see what is the correlation between them, right? So if the correlation between the S&P 500 and the correlation or uh, uh, the factor, right? Factor loading of the broad market towards S&P 500 is captured by beta, and in our example, it was like 0.95. I mean, if I remember from our last, yeah. So in other words, uh, S&P 500 is not the benchmark. I mean, they are not the same. The benchmark is broad, uh, 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 really broad-based, market, like with more than 4,000. As I explained, it's not just stock. It has to include a very broad financial market. Uh, in other words, macroeconomy. So not only stocks, but bonds, real estate, foreign exchange, commodities, Uh, but even if you do not actually include all of them, even a broader stock index like Russell 4000 would clearly be a broad a broader market than S&P 500. And so the factor loading, for example, if beta is 0.95, uh, risk-free T-bill will be 0.05, and if you short the benchmark and the T-bill, then because you short sell, you short sold, there's proceeds of funds, and you put all of that into S&P 500. So the weight contribution to excess return will be, because it is one, you put 100% into S&P 500. That one will exactly be 1 times this thing will be alpha plus beta. The excess, the benchmark excess return, and so on, residual, and the benchmark, the weight of the benchmark will, because it is, exactly, negative beta times, if you multiply, and risk-free asset has, because there's no correlation, right? Between the risk-free asset and the S&P 500 portfolio, it will have to be 0, right? So if you calculate, this is, basically the just like capm specification, and if we take, expectations, operator, in other words, the, the mean value, right, the forecast, right, return on the because the residual on the well-diversified portfolio is mean of the residual, its white noise is going to be 0, so it's going to be exactly like this, because this term is going to drop out. So the concept of well-diversified, the concept of well-diversified portfolio is very important, because if it is not well-diversified, it's not, we cannot, we cannot anticipate this, we cannot, bet this is going to work. Now, the arbitrage portfolio A with excess return, this excess return, right? Is still risky as long as the residual is variance of the the variance of the residual is positive, right? Which means, if it is, if it looks like this, then it's still risky, right? But that's why we need well-diversified portfolio, so that will be minimal. However, zero investment, zero beta, positive alpha portfolio is not necessarily arbitrage opportunity, because true arbitrage implies no risk, right? Just because you have positive alpha, zero investment, zero beta. Zero beta means they cancel out. Oops. Right? Eventually, think about it. If you sum all these, right, because it's weighted average, right? these two will cancel out, so 0 beta, right? Eventually, what you're left with is, alpha of, S&P 500 and the residual of the S&P 500, right? So in other words, the problem is, if we have this, right? If we have, a significantly positive residual, then that's not true arbitrage, right? But if S&P 500, our portfolio were highly diversified, it will be negligible, right? Portfolio with practically negligible. So this well-diversified portfolio concept, I've been telling you, it's almost haunting. It keeps on haunting. And our question is then, is S&P 500 sufficiently well-diversified? Why? Although there are 500 companies in S&P 500, right? But the 10 largest firms in S&P 500, they are 10 out of 500 companies. So in terms of number of heads, right? In terms of head count, it's only 2%. It's only 2% of the index. In terms of head count by head count, right? But in terms of weight, it's almost 20% of the market capitalization, right? So if it is, so it's kind of skewed, right? This is, as I said, head count. In terms of number of companies. So our question is, can we really rely on, can we really count on it, right? Can we really count on it to be sufficiently well diversified, right? So in terms of market capitalization, yeah, look at the weight. That means, in market capitalization, the weight of all, these 10 companies are like almost 20%, right? So let's take a look at the some statistics of the regression result of S&P 500, right, on benchmark, and during these over this 5-year period, right? January 1st, 2006 through December 31st, 2010. This 5-year period, right? And R square and adjusted R square are quite high. Now think about it. Why is it so high? And look at the correlate. Because it's like Russell 4000, right? You regressed S&P 500 against like Russell 4000 or broader. I mean, it's stock market on the broad stock market against broader stock market. There should be clearly a good correlation, right? And the standard error of the regression, right? In other words, standard error of regression, right? Maybe I should. Is like 0.5968. Is it good? And it's monthly data, right? We are using monthly data. Is this small? Is it, how can we, well, because it's returns data, it's percentage, right? It's percentage because it's return, right? So this is monthly, and it's so hard to, okay. So you would understand that this means monthly, right? So that's, percentage, right? So let me, seems, a monthly, this seems pretty, seems kind of small. Annually, if you annualize it, right? Annually, it is, right, 2.067. How do you annualize it? You remember the variant, I mean, the growth, the standard deviation grows by, square root of time. Remember that from, efficient diversification. We talked about this, right? Standard deviation grows at square root of time. So if you annualize it, times, square root of 12, then it comes to 2.067. So even, when annualized, this is just about, 2%. So seems like, but how do you know if it is, large or small, I mean, again, that's why we will talk about this further in the following following slides, but for now, it seems okay. I mean, it doesn't seem that big, right? Monthly, just in other words, what that means is, this monthly, standard error is only about 0.59, and annually just about, only about, 2 point something, 2.7 something, right? And think about it, if alpha is 10%, right? Uh, it's it's just an example. It's a totally different example, right? I mean, this is just random. This is just a random graphic representation, but let's see what alpha is. Compared to alpha, is the error. So alpha in this annualized alpha monthly, this is, regression results. So alpha is monthly like 0.1909 and negative, right? And don't worry about it. If the alpha is negative, we simply need to apply, uh, the uh, we apply the weights in reverse, right? And we will always have positive alpha, right? Um, if you annualize it, we know how to annualize it, right? Right? 1 plus r raised to 12 minus 1, right? Geometric average, right? Annualized, these are all, percentage, of course, because we are talking about uh, monthly returns, right? This is a coefficient. I'm sorry, the coefficient. But alpha is, percentage, anyway. Alpha is percentage, although beta is not percentage, alpha is percentage, right? Because it's, vertical intercept. So if you annualize, it's going to be negative 2.27. And the standard error came out to be like this. Benchmark, beta of the benchmark portfolio is, that's pretty high. I mean, high correlation. Of course, it will have to, you will have to have, what do you expect? You will have to have a high correlation, right? Overall, overall R square is high. But, just because it is, it seems, close to 1, but then, again, what's important is t-statistic, right? Remember, t-statistic, you have to check the t-statistic. If the t value is low, and this t value is very significant, even, right, very significant, even the alpha, very significant. So that means, this is, I mean, you divide this by this, t-stat is, dividing this by this, dividing this by this. I mean, to be, more true to the theory, this minus 0 over, and this minus 0 over this, right? But anyway, that means these are very robust. This is not a frivolous, estimate. This is a very robust. Robust, regression results, right? It's not frivolous, right? Robust regression results, right? So it seems like, and it seems like, we are getting, we got relatively well-diversified portfolio because, the standard error of the regression is seems, negligible. But how do we? I mean, compared to what? I mean, what is the reference? What is the reference point? I mean, empirically, you can tell it is, small regression error, but based on what criteria can you, decisively say that it is, a well-diversified portfolio? That is our next question. But, let's uh, let's see what, table 7.7, this is table 7.7, both annual alpha which is negative 2.27, is like approximately same as 2.23% predicted by in 2005 prediction was 2.33. And I was wondering, where was that prediction made? I think it was, I wonder if that was mentioned. Okay, that's not. Where was that mentioned? I think this was yeah, I think it was, following 5-year prediction, right? And then the alpha was like, uh, alpha was here. So this is the part that I, can that I'm struggling with because there's no, um, background data, right? I'm trying to, I mean, I'm trying to correlate it with the because this is to end of 2005 forecast, right? And risk-free rate is 2.2. I mean, that's the only thing that is close to uh, that 2.23 that they just popped out there. But then it's not just, this is, risk-free return, and what we are, the regression statistic, the regression result, they are talking about there is alpha. So unless alpha is, only like 0.03, right? You cannot, uh, that's not alpha, right? I mean, you cannot um, uh, equate this with that, alpha value because this is only uh, risk-free, right? T-bill. And in that uh, arbitrage model, right? Alpha was 1.34. So I'm not sure. I can't really make sense of where they got this. But anyway, if they if this was like if they were talking about, was this RF, right? Was it otherwise and you might say, this is negative and this is, positive. How can that be even equal? I mean, approximately equal. No, no, it doesn't really matter because alpha can be always, it can be turned into a positive by, applying reverse weight, right? Reverse weight. And in that model, 2005 prediction was of beta was, 0.95. It was 0.95, yes. And our S&P 500, regression uh, against broader market benchmark uh, was 0.93. So they are approximately, I mean, the forecast that was made at the end of 2005 are pretty much coinciding with our regression result. And annual right standard error right? Residual of, S&P 500, which is in our arbitrage portfolio, 2.067, right? That's, we know, annually. We know that's what we got there, 2 point, and still the question is this small enough to deem S&P 500 well diversified? So we will have to, so I said, what is the criteria? I mean, what's the reference point? I mean, compared to what? Can we say it is small, right? Small enough? Can we, how can we say it's small enough, right? Small enough. Well, so the criteria, we'll talk about the criteria. So it will only be determined by the marginal risk, right? Marginal, we understand the concept of marginal, right? So are we, adding marginally, the concept is, our marginal risk by adding this, S&P 500 portfolio, what will be the we will definitely, because we are taking on risk, right? There should be, marginal. We will inevitably face marginal risk, or incremental risk. And is incremental risk, significant compared to the previous, state before taking on additional risk? Well, to talk about that, we will need more time. And we are out of time, so we will be discussing more about the marginal risk, in the next session, or next segment of the video. Alrighty, so I'll see you guys in the next video, and for now, I'm gonna have to stop recording.